All right, good evening, everyone. Just let everyone get loaded in here, and we will get started in 1 second. And okay, well, let's get started for the evening because it's hard to believe we are already at October 17th here through 2024. And it is our 10th webinar for the year. And this month, our topic is on charitable planning. So kind of to run through our normal housekeeping items, so the webinar is being recorded. So for all of you with us live, we appreciate you joining us tonight. For all of you watching the recording, thanks for taking the time to watch the recording. The session will probably be about 45 minutes in total. There will be at the end questions, but if you have a question at any time during the presentation, if you want to use the chat feature or the Q&A section, put that in there. I will be manning the chat. I'll make sure that we cover that topic before the end of the night. All right, so let's kind of get right started into our topics here. Our quick little disclosure. So I'm going to be one of the presenters tonight, as well as the moderator. So most of you know me by now, Michelle Boyce. So this is my 20th year anniversary. Actually, this month, was when I started in the financial services industry back in 2004, and I joined Rosenzweig Financial, 3 years ago, actually. So when I joined Rosenzweig, my background's really been, comprehensive financial planning, with my areas of expertise being in the retirement, estate, and also charitable planning, which is where this webinar came from tonight. And then I have the honor of having a distinguished guest with us the evening. That's going to be my co-presenter, as Jenna Watasha, which I messed it up.
You got really close, really close.
I had it and then I lost it.
You got really close. Jenna was shotgun. Thank you so much for
Washaka.
having me. And I'm over here trying to make sure I pronounce Rosenzweig correct. So I'm with you.
So as you can see from all the credentials, Jenna is a JD, so she is an attorney. She's also a CLU, CHFC, and CHSNC. Say that 3 times fast. And Jenna joins us tonight as she's one of the directors with the advanced sales at Penn Mutual. So she has 10 years experience in this platform. She's also securities licensed. And as an attorney, her areas of specialty are within, the estate planning side, charitable planning, special needs planning, everything that falls into that. So for those of you that don't know, we have a relationship with Penn Mutual, and we're able to go and use their experts. So there's Jenna and her team, we've got from attorneys from different backgrounds and experiences that are take complex matters, and we're able to go to them and use them as a resource. And charitable planning is one of those topics, which is why Jenna's joining us this evening. So let's get into the meat of our presentation. So charitable planning. So when a lot of people think about charitable giving, they instantly think, well, I'm giving money to charity, then that's less money for me, for retirement, or for my legacy, and they see it as this seesaw, as you can see with my cute little pigs there, right? That if I give money away, there's less money for me, which is why a lot of people, even though maybe they want to be charitable, they don't feel the comfort that they can do that because they're not sure how that's going to impact their retirement. What we're going to talk about tonight, though, is that you're likely going to have money left over at some point. You're going to have some sort of legacy. The question is, where is that money going to go? And it's really going to go to one of several different places. So the first place, which is usually everyone's least favorite, is the government, right? And when I say the government, I mean that in the form of different taxes, from income tax to estate tax to state estate tax, right? Probate tax. So, we get taxed in a lot of various ways, and we're really going to talk about that tonight. And another place that money can go is corporations. Now, Jenna, do you have an example there of like how money could go to different corporations?
Yeah, I think it to some extent, I really like the thought of really wanting to nail down who it is that you want your legacy to go to. And the rule of thumb that I've always heard is that you can pick usually two. So like between the government and the charity and your family, you can pick two of those three. So which of those would you like to pick out of those three?
Yeah,
In terms of yeah, in terms of
yeah,
corporations,
that's a good rule of
financial,
thumb.
exactly, exactly. So it's sort of like pick the ones that you'd like it to go to. But I think also of things like creditors, for example, or probate costs if you haven't done the right kind of planning, sort of these unexpected costs along the way that you aren't really, it really isn't where you wanted your money to go.
Right, right. Now, another place is other wealthy people. And sometimes people don't think about that. And we've all seen, either online or back when there were newspapers, like an estate sale. Someone has a lot of nice stuff and now they're selling it to other wealthy people because they have to raise money to maybe pay for those unexpected costs that you just mentioned.
Mm-hmm.
Now, and then there's the last two, charity and family. And with my 20 years experience, and Jenna, with your experience, I will say I haven't really met anyone, and I'm sure you would agree, that out of that list doesn't pick family or charity as the top two, right? If
Yeah.
they have a choice, they would like it to go to those two places.
Mm-hmm.
So tonight's conversation is really going to talk about, I have highlighted there in yellow, the government and charity, and how you can use charitable strategies by being charitable to really disinherit the government, which in turn is going to leave more money for yourself, your family, and charity. So that's going to be the whole concept of everything that we talk about tonight. We've got a couple of different strategies that we're going to share with you. They're not the only strategies, but Jen and I could talk, for hours on different strategies, which we probably wouldn't be able to keep your attention for. So we picked four good ones that we're going to talk about tonight.
Sounds good.
Okay, so most of you probably have heard by now of the Secure Act, right? But if you haven't, Jenna will give you a little insight of, what the Secure Act is and what
Yeah.
the change was.
Yeah, absolutely. So, Secure Act had a pretty sweeping impact in terms of the retirement planning landscape. But I think for our purposes, one of the biggest things that impacted was it eliminated what was called the stretch IRA as we know it. And if you're not familiar with this term, or if you have heard it, this was the idea that for the longest time, we felt like IRAs were really great wealth transfer vehicles. And by that, I mean they were really good vehicles to leave to your kids, to your grandkids. And sort of in the meantime, it's this great retirement savings vehicle. So I can save for retirement. And the reason it was good to leave to my kids or my grandkids is because they had the option in a lot of cases to what's called stretch the IRA over their lifetime. So if they inherited the IRA, they could take the distributions out. They really didn't have minimum distributions beyond just a certain amount each year. And the reason that was nice is because it allowed the wealth to continue to grow tax deferred, to compound within the IRA. And that was really the name of the game, was the stretch IRA. Well, as you can imagine, the IRS got a little bit tired of that because they weren't getting their money fast enough. And so unfortunately, the Secure Act really eliminated the stretch IRA for most non-spouse beneficiaries. Now, there are some exceptions. The most common is if I'm leaving it to a spouse, they can still typically stretch the IRA over their own life expectancy, or they can take it as their own IRA. Lots and lots of flexible options for a spouse, I guess, is the punchline. But for most non-spouse beneficiaries, they have what's called a 10-year rule, which is that the IRS wants their money within 10 years. And this is hugely complicated. There's so much more than what we are able to share in the webinar tonight. But just suffice it to say that for most of your non-spouse beneficiaries, they're looking at a 10-year force out after death of the original IRA owner, which means, again, another punchline is that IRAs are no longer a great, what we call wealth transfer vehicle. So IRAs are not a great vehicle to leave to kids, grandkids as a general rule, just because of this. If you think about it, a lot of the cases I work on, you have an IRA owner who maybe they're retired, they're in their older years, they're in a very low income tax bracket, and they're potentially leaving the IRA to maybe their kids or even their grandkids who are in some of their highest income tax brackets during their working years. I know that's not everyone, but if you think about, okay, maybe my kids or my grandkids are in their highest income earning years and they're going to have to be forced to take this money out in 10 years, that's potentially bumping them into an even higher tax bracket, really creating a very bad planning arena. So that's what we're getting at by bringing you up to speed on what happened with the Secure Act in 2019.
Yes, thanks, Jenna. So that summarized it perfectly. It's exactly what she said, the punchline. It is now the IRA is one of the worst assets to leave to the next generation because the taxes, right? And it all boils down to the taxes point of it. So the government's getting a lot more now of that balance in the form of taxes than it is to your heirs, which ultimately was your goal.
Yeah. And I didn't even get into estate taxes. That's just income taxes. So I'm with you, Michelle.
Exactly. Yes, just income tax. So now the complete opposite, right, of a traditional IRA. And when we say IRA, that's any retirement dollars, anything that's tax deferred. Okay. Now the opposite is a Roth IRA, right? And a Roth IRA has, it's still an IRA, but it has very different features. And I went the wrong way there. So first, it grows tax free. So versus a traditional IRA that's tax deferred, and then you have to pay the taxes when you use it, an, a Roth IRA, you pay taxes, you contribute with after tax money, and then all of that grows tax free, which then in turns means you have tax free income, no required minimum distributions. So when you turn 73, you don't have to start pulling out income like in a traditional IRA. And the biggest one, and why we're talking here, is it passes income tax free to your heirs. So it's still subject to the Secure Act where they have to spend it down over 10 years, but it's income tax free. So it doesn't create the same type of problems, right? So this is why everyone really should have a Roth IRA, but a lot of people don't. And you might be thinking, well, why don't I have a Roth IRA? And why don't more people have? And it's for several reasons. One, potentially if you're an employee, right? If you work for a corporation, and maybe your employer doesn't offer it. More and more employers are starting to put in a Roth 401k plan, but for the longest time, most individuals, most employers didn't, right? I think that was also one of the things that came out of the Secure Act, right, Jenna, or the Secure Act 2.0 version. They were more and more Roth 401k options.
Yes.
So second reason is maybe your income is above the limits. So I like to call this the success penalty. So the IRS has put an income limit on those of who can and cannot contribute to a Roth. So if your income's over a certain level and you file single, which I believe is around like 160,000, if your income's over that, they say, sorry, you make too much income to be able to contribute to a Roth. If you're married, it's more obviously because they're taking the joint income, but it's like I think the $260,000 realm. So if you're a high income earner, or you're a joint household income, you probably make too much money to contribute to a Roth. The third way to get a Roth is to do a Roth conversion, but a lot of individuals don't want to pay the taxes on converting that IRA to a Roth. Because they don't want to take that money out of maybe their other investment account or pay it out of the IRA itself. So they're just sitting there letting that money compound and compound, but the taxes continue to compound and compound as well. So if you don't have a Roth IRA or a 401k, you probably are for one of these reasons. But we're going to concentrate tonight for a few strategies on that last point of saying, well, what if you could convert that IRA, okay? And what if you could convert it without paying the tax? So I'm going to say that again. If you have an IRA and you could convert it to a Roth, which we covered what all of the benefits of the Roth are of tax-free growth, no RMD, tax-free to your heirs, what if you could do that without paying the tax, okay, for no tax? Instantly your reaction should be how, right? Because we are all a skeptic. Like, how are you doing that? And I promise it's not magic, right? We are just working within what we know of the tax code and charitable strategies to be able to do this. And that's the whole premise of our conversation tonight, is how can we use some of these strategies to create more wealth or larger tax deductions that then allow you to convert some of your IRAs to a Roth. Okay, so we're going to cover these four tonight. We're going to talk about donor advised funds. We're going to talk about charitable remainder trusts. And both of those are really going to be around the concept of getting a deduction to use for a Roth conversion. We're going to talk about some giving strategies that will help on the estate side with charitable owned life insurance, and then qualified charitable distributions, or what we call QCDs. So that is our agenda for the evening. So let's start with the easiest concept of a donor advised fund. Okay, because I think it's easy, it's best to build our baseline when it comes to these topics and then grow above that. So a donor advised fund it's pretty simple, actually. Most people think it's complicated, but it's kind of pretty simple. It's just an investment account, just like an investment account you have right now with us. Looks like a brokerage account, but it's wrapped in a charitable account. So it has that charitable wrapper around it. And it's basically an account that says, okay, the money that I've put in there, I've now earmarked this money that it's going to charity. But I have control over how much I give and who I give it to over the course of time, right? Because you're putting that money into that donor advised fund today, the donor receives an upfront tax deduction. So, pretty simple. But how can we use this now into a planning technique? Okay, so this is actually a real case study that we have with a client. So, and Jenna, at any point in here, kind of jump in with anything. So they were giving $10,000 a year from their cash flow to different charities, right? It was like 2 or 3 different charities. And their plan was to continue doing that throughout retirement. They wanted to keep that up. Okay? Because they were giving 10,000, and with their other deductions, they really couldn't itemize that. They were just taking the standard deduction because they didn't have enough other deductions to get above the standard deduction. So they weren't really getting any huge tax benefits from that 10,000 contribution. But since we knew it was something they wanted to do throughout retirement, we said, well, what if we take kind of 10 years of those contributions and put them into a donor advised fund? So we took $100,000 of their non-qualified money and just relabeled it into a donor advised fund. They can still give that same $10,000 a year, but now rather than giving it from cash flow, it comes out of that donor advised fund. Right? So nothing changed on their planning on their charitable giving. But here's where the impact came. Because we're now giving $100,000, we have a charitable deduction. Now we're able to itemize because we have a much larger deduction. And they were in the highest tax bracket. So they were getting, rather than just taking the standard, they got a tax deduction that year of about $35,000. Now, what could they do with that $35,000? They could use it to offset income, but where they got the largest overall return is we took $35,000 of their IRA then and converted that to a Roth, because now we didn't have to pay the tax because we had the tax deduction to offset it. Over time, the savings of taxes and the savings from the RMDs, they ended up with pretty much in the same spot as they would have been on their current plan, even though they gave $100,000 to charity. But if tax rates go up in the future, they're in a much better spot because they have less money in their IRA now. Okay, so again, it's kind of a simple concept when you think about it, but it has these other rippling effects. And the more money that goes into it, obviously, the more money you're giving to charity over time, but the bigger tax deduction that you also get over time. So that's a donor advised fund. So you've probably heard about them on TV, possibly heard from someone. Now you have it broken down into pretty simple terms. Now going up one level from a donor advised fund, we'll talk a little bit of kind of what is a charitable remainder trust.
Yeah, yeah, absolutely. And I think these are such cool ideas because it just gives you some different ideas to think about, some food for thought. Certainly lots of different planning strategies, and there's no one size fits all, right? Like everyone's going to be a
Exactly.
little bit different, and everyone's situation is going to be a little bit different. Um, and I think certainly I'll add sort of my own disclaimer, which is that I mean, for all of these, we would certainly encourage anyone who's considering these to look at these with their own tax and legal advisors because again, a lot of these strategies might differ for your specific situation, but I think there's some really cool things out there that not a lot of people that you don't always know about. So that's really what we want to do today is share some of these cool ideas. Okay, charitable remainder trust. I'm sort of dragging my feet getting into this one if you can't tell. Okay, so it is actually the concept is very simple if you go really high level with it. Charitable remainder, it's sometimes called a CRT for charitable remainder trust, and really the trick is in the name that you are setting up a trust that will have a benefit that ends up with charity in the remainder goes to charity. But basically what happens is it's called a split gift because that's the way that the tax code treats it. But you make some kind of irrevocable gift. So I am giving up some kind of asset. I see this done a lot with, for example, um, it might be like a highly appreciated stock portfolio that, hey, if I were to sell that, it would have a big capital gains bill. I also see it with highly appreciated real estate, like a vacation home that the family no longer. Wouldn't that be nice to have, Michelle? If we had like a vacation home sitting around, we didn't
We
need.
no longer need.
I don't need it anymore. But I do actually see that a lot with like those kinds of assets that they're not something that I'm interested in donating to charity, but that if I were to sell it personally, I would get a pretty big capital gains hit on. So that's where I tend to see it as like a highly appreciated property, but it's an irrevocable gift and you donate it into the trust. And there's CRUTs and CRATs. There's different alphabet soup depending on how the attorney sets it up, how your attorney sets it up. But basically, in exchange for giving that asset up, rather than just giving it outright to charity, if you give it into this trust vehicle, the CRT or the CRAT, you end up with a couple of things. One is you get an income stream back. So you're donating an asset, and in exchange, I get an income stream back. And it's typically for either my lifetime or a period of years. There are all different ways, as Michelle knows, to set these up because she runs the calculations, which I love. Um, but that's one of the things that makes this an interesting strategy. And as I mentioned, the remainder that's left at the end of either that term of years or at my death, the remainder goes to charity. So that's why it's called a charitable remainder trust. Now, the taxes, I think it's helpful just to get sort of our arms around what's happening with the taxes. So because I am irrevocably donating something to this charitable trust, I do get an immediate income tax deduction. And depending on how we structure it, really how much income I'm getting back, that can vary. And there's a whole calculation that goes into it, as you can imagine. But that is very, very useful. You also get some estate tax savings because now that asset is outside of my estate. Now, I know Michelle does have this in that first bullet there, and I think this is important to keep in mind that that income stream that I get, that is taxable to me. So I do get some income tax. It's not totally tax free, but it is a way of sort of spreading that out over time. And in a way, if you think about it, let's say it was highly appreciated stock and I donated that to the CRT. Well, what happens is the CRT, the trustee, then will sell that stock or liquidate that asset. And because it's a charitable trust, it doesn't pay tax on the gain. And so, in a way, you've sort of disinherited the IRS of quite a big amount. So, it's kind of a cool strategy if that's what you're looking to do. And then, as this last bullet mentioned, depending on again how we structure that, you can potentially do it in the same year that you're doing a Roth conversion. And the other thing about Roth conversions that's kind of cool is you don't have to do it all at once, right? It might make sense to do it all at once if that's the year that we get the big income tax deduction. I think that can make a lot of sense, but you also can spread these things out over time depending on the circumstances. So yeah, that's a CRT, charitable remainder trust.
And the CRT, I don't know the exact date, but they've been around for a long time, right? These are not new strategies. The CRT's been around for,
Time tested.
yeah, 60,
Yeah.
like 70 years, like a long time it's been around. So what I'm going to share with you next is this, what I like to call the CRT Roth conversion strategy. So this is a strategy that has a lot of moving parts, but it's really great for individuals, just like Jenna said, that have highly appreciated assets, right? Also potentially maybe have an estate tax problem, because we can get a lot of estate planning out of this. And then also are looking ways to reduce income tax. So I've put together kind of what the strategy works. And then in the next slide, I'll put some numbers to it. So we take that highly appreciated asset, right? And it has to be non-qualified. And I realize I throw the term around, and others like myself, throw non-qualified around, and people are like, what does that even mean? It really means non-retirement assets, right? Something that's not an IRA, something that's not a 401k, that's non-qualified, okay? You take those assets, you put them inside of the CRT, right? The Charitable Remainder Trust. When you do that, you immediately get three different benefits, as Jenna just said, right? The first is you can sell that asset without that capital gains hit. Second, you get that income stream that's going to come off each year. And then the third, you get the tax deduction, right? Now, you could do this strategy and end it right there, right? I know attorneys that use CRTs for planning to help with the estate tax and for the capital gains tax on a highly appreciated asset. This strategy takes it one step further. So with that tax deduction, right, now because we're putting large sums of money in there, we're getting large tax deductions, we're able to convert a portion of your IRA to a Roth. We're going to take that income or a portion of that income that's coming off the CRT and use that to purchase life insurance, because the money that goes into the CRT, it's irrevocable. You're not getting that money back. So we're going to purchase the life insurance to replace that asset in the future growth. And then whatever is left at the end of the period of the CRT is what goes to charity. Rule of thumb, it should be at least 10% of the initial starting value to really kind of stay kosher with the strategy. So I like to use the analogy that you're sitting on the side of a pond, right? And your highly appreciated non-qualified funds are your rock. And you're going to throw that rock into your pond. Your pond is your CRT. When you throw that rock in, you get all of these ripples, right? We all have seen that within a pond. Your income, your tax deduction, your capital gain savings, those are all the rippling effects that you get from putting that $1 into that CRT. This can create great additional wealth for families if it meets their goals. So this is an actual case study, just kind of simplified it down into their two separate assets. So at the time that I met them, they were both 62. They had 1.4 million in their IRA and 2 million in non-qualified. And it had a low cost basis at about a $500,000 cost basis. So we just ran some calculations moving out with our different financial planning software. First on the IRA, saying, okay, if they're from 73, when the RMD kicks in, if they said, let's see out to age 90, how much do I have to pull off that 1.4 million? And they, with those calculations at a 7% rate of return, they had to pull out 3.5 million. That is the government saying you have to take that income if you need it or not. Okay, it's required. They're going to pay taxes on that 3.5 million, which is that orange bubble there of 1.2 million. And then they're going to leave 3.5 million of that IRA to their heirs, which is fully taxable, as Jenna explained, and they have to eliminate it basically over 10 years. Okay. Now, the first thought a lot of people get when they see these numbers is, well, if they had started with 1.4, how'd they take out 3.5 and how'd they leave 3.5? Those numbers don't add up. Well, first, I have a saying that if you've worked with me, and it's a great here, math isn't money and money isn't math, okay? Math is 1 plus 1 equals 2, right? 1 plus 1 plus equals 2 will always be that in 20 years and 50 years and 200 years. But $1 plus $1 isn't always going to give you $2 because money has eroding factors. Okay. So here in this example, that 1.4 was going to grow and grow and grow till they had to take that RMD. The RMD starts at a very low amount, about 3.5% at age 73. So therefore, if it's growing at 7, it's still compounding, right? So it really isn't usually till your mid 80s or later 80s till you're starting to actually invade, till your account balance is going down, which is why we have these large amounts left in IRAs. Okay. But kind of fast forward here. Basically, when we did the projections, they were going to pay 3.2 million in taxes while they were alive. Their heirs were going to pay 1.2. Between those two assets, they had a taxable estate of 16 and a half, which we were using when the law sunsets in 2025, if they had an exemption of 13 million. We're not sure what it will be, right? But that's just the number that they wanted to use at that point. So that gave them a taxable federal estate of 3.5 million. So at 40%, they're going to owe 1.4 in taxes, that their heirs are. They actually also lived in a state with state estate tax, but I kept it off this equation so it didn't get too miserable. Right? But
Right.
basically, after tax, the heirs were going to get 13.9 million, right? And the government got 1.4 at death, and then they've got their income tax here. So we showed them the Roth conversion CRT strategy. Okay. So I'm going to just bring everything up here. But basically, of that $2 million that was in non-qualified, we took $1 million of that and put it into the CRT. Okay. So they were able to sell that asset without getting that capital gains hit. We had a 5% distribution rate, which gave us $50,000 a year of income off the CRT, and an upfront deduction of $300,000. Okay. Over a few years, we were able to do a conversion of the Roth to a Roth for $300,000, which reduced the IRA balance. And then it just kind of takes everything out to that same age 90. And we use that $50,000 to buy the life insurance to replace the million and the growth, because that bought 4 million of death benefit. What's this mean bottom line? Okay. So the current plan's on the left, where the heirs were going to get 13.9 million, but they paid a lot in tax along the way. On the light blue is the comparison. So during the client's life, they're going to, rather than pay 3.2 in tax, they're going to pay 2.5. So they're saving a significant amount in tax. Okay? Then the heirs, because there's less money left, sorry, let me say that again. Since there's less money left in the IRA, the heirs will pay less tax. They pay 950 versus 1.2. So there's a significant tax savings between those just on income tax. Because the CRT is outside their estate and the life insurance was outside of their estate, we got their taxable estate down to 11.4 million. With the assumptions we were using, put them under the federal limit. Therefore, they had zero estate tax. So even though we gave $1 million to charity here, the heirs are still $600,000 ahead, and the gift to charity anywhere between 2 million to 2.5 million, whatever the value is left. And we put them in a much more defensive position if there's tax increases. So that strategy is not for everyone, right? But it is a really great strategy if you are the right client and all those different things are important to you, to be able to pay the least amount in tax and leave the most to your heirs. All right. So
I
Jenna,
really love No, I really love how that I think that's a really good example of that rule of thumb, which again I stole. That was not my rule of thumb, but the rule of thumb that like if you're looking at who are we going to leave wealth to, are we leaving it to charity, to the IRS, or to our family, you can pick two of the three. And so it was like in your first example, we picked the IRS and family, but in the second
yep.
example, we're choosing charity and family. And there are cool things to do to disinherit the IRS if
Yeah.
that's what you're looking to do.
Yep.
Yeah.
And most people would have, on their own, most people are not going to be thinking of that strategy. That takes a
Yeah.
lot of different professionals, which we'll talk about later in the slide. And Jenna already mentioned it. But the reality is those are the types of strategies that are out there that individuals can take advantage of. And there's
Yeah.
nothing wrong. There's nothing illegal with it. Like that's all how the tax code is written.
And I can talk a little bit about this side. So one of the things that we're seeing sort of next level. So that was CRT already next level. This is like next level, I guess, is that one of the cool things that we're seeing people do with CRTs and IRAs is, hey, okay, we acknowledge that IRAs, that second bullet there, we acknowledge that IRAs are not great wealth transfer tools, right? That's something we talked about thanks to the Secure Act, which eliminated that stretch IRA for most of our non-spouse beneficiaries. So what we're seeing a lot of people do now as kind of an alternative for someone who still wants that idea, they still want the concept of the stretch, where maybe I've got beneficiaries who would be well suited for having a plan that stretches their inheritance out over time. I can certainly think of the clients that I've worked with that have wanted something like that, where rather than their kids or grandkids getting a lump sum, they think something stretched over time could make sense and can also make sense from a tax perspective. So one of those like mimics that we're seeing, really the closest thing that we still have to the true stretch IRA, is to do what this third bullet says, which is you can actually, so when you have an IRA and you have the beneficiary designation form, you can name individuals, but you can actually also name a CRT. So rather than in that first example, we were donating a current asset, like you're donating, I know we talked about non-qualified funds, or you're donating real estate, or you're donating, maybe it's appreciated stock. In this example, we're actually filling out the beneficiary form to name the CRT as a beneficiary. And the way that that works is then at my death, the IRA pays to that CRT, and then the CRT can stretch that distribution over, again, the term of years or for life expectancy. And you typically have your income beneficiaries are usually my kids or my grandkids. And then the remainder, because it's still a charitable remainder trust, the remainder goes to charity. But that's a way of stretching out the inheritance and also stretching out the tax because of the fact that that income stream is taxable as it comes out. So that's kind of a cool strategy. And we certainly recommend some kind of life insurance on that income beneficiary level, because if the absolute worst were to happen, and let's say something happened to the kids or the grandkids prematurely, if you have life insurance on their lives, that can make sure that their families are protected if that income stream is cut short. So lots of different strategies here, but that's probably the closest thing that we have to your true stretch IRA in today's world.
Yes. And like you said, it's a different type of tool that most people aren't thinking of. Like,
Yeah.
and what I like, it brings back some of the control, right? Because what people liked about the stretch IRA is that they could control how they took it. They could stretch it over their life. They could take it over 5 years. They could take it over 15 years. One year they want to take a little more than the other year, they could do that. Now the CRT obviously is a little more, has a lot more, has rules around it, and it's not as flexible, but it still gives you that control, gives you a lot more control than just over a 10-year period. Okay, so a QCD. So those strategies we talked about so far really, talked about the taxes, saving on the taxes, and ways that the grantor basically could save on taxes. A QCT is a little bit different. It's still saving taxes, but it's really giving a direct gift. So we see this a lot for individuals who, when they start their RMDs at age 73 or later, and they don't need that RMD, right? And they don't really want to pay the tax on the RMD or even take the income because it's going to bump them up a tax bracket. Well, they can do a direct gift, like a direct transfer from the IRA to a qualified charity. They never take possession of that money, so therefore it never doesn't become part of their AGI. They never pay taxes on it. So they could do that directly. You can do up to $105,000 per year per person, right? and it satisfies your RMD. That's probably the biggest point there, is that even though you're not taking it, it's satisfying, you know, your mandatory RMD. So that's just a planning concept. If you want to be charitable and you're not sure what money to use, this would be something that we could look at and say, well, maybe we look at doing QCDs because it's going to save you from jumping up to the next tax bracket, or it's going to save you, 200,000 in taxes over your course of your life, or something like that.
Absolutely. I think QCDs are the coolest thing. I really love these because they're just such a cool income tax strategy for someone who's charitably inclined.
Yep.
They're already giving to charity anyway, and especially for someone. So one note Michelle and I had talked about that I had recently learned is that that third bullet, if I do want my QCD to count towards my RMD, I have to do it first. So if you do the RMD first, but then you go back later in the year and decide to do a QCD, it doesn't work. So you've got to do the QCD first. So I think especially kind of going into the next year, if that's
Mm-hmm.
something that I'm interested in doing in 2025, it's the timing has to be done right because once you take your RMD, there's really no do-overs. But it can be really, really cool if you do it in the right order and for the right person.
All right. Now going to life insurance and charitable giving.
Yeah. Yeah. So this one's me. So this is just the idea, and I think this one's really, really sort of a simple, elegant concept of that it's not an official endowment or anything like that, but I can sort of be an endowment creator for a charity that I care a lot about by using life insurance, whether it's an existing policy that I have that I no longer need, or whether I'm buying a policy to benefit my charity. Um, and it just sort of gives you that kind of, I don't know, it feels good that you know that if the worst should happen, that you've got this life insurance policy that, and it doesn't have to be that all of it goes to charity. You can typically, depending on the life insurance carrier, specify a percentage or a certain amount, depending on the carrier, but you can say, hey, I want my charity to get X number, X percent. If you simply name a charity as beneficiary of your life policy, the general rule is that really the only tax benefit you get is an estate tax benefit, which can actually be very powerful for someone who has a sizable estate or they live in a separate state that has a particularly bad estate tax. This can be a cool thing to do. And again, it's that way of creating a legacy, creating endowment. And the nice thing about that too, going back to control, is that I stay in control of that policy. All I'm doing is naming the charity either a total or partial beneficiary. And then down the line, my estate gets some estate tax benefits. But that doesn't really give me any current income tax benefit. That's more of an estate tax long-term type play, but still very powerful. And I think very maybe even often overlooked in because it's just so simple. Like it doesn't seem like it should be that simple, but it can be. The second idea up here is if you actually are interested in the current income tax benefit. So the way this typically works is rather than having a charity just a beneficiary of a life insurance policy, actually having the charity be the owner of that policy. So the policy owner, so the charity is now the one that's in control. If you do that, the way that it typically works is that each year, as I write the premium check, rather than sending my premium check to an insurance carrier, I make a cash donation directly to charity, just like any other cash donation that I make, and I get my receipt. And it depends on what level of charity it is and whether it's public charity, but it's all those same rules. It's a cash donation. And then the charity turns around and submits that check to the insurance company. That provides all the income tax benefits that you get with a cash donation to charity. Now, the one thing that I have to be very careful about is because this is subject to underwriting. And by that, I mean every life insurance carrier has different rules about charity owned life insurance. Some of them are more comfortable than others. Mine that I currently work for is not super comfortable with it. So you have to work with a carrier. You may not be able to do this with Penn Mutual, that second part, but in the cases, the carriers that do allow this, what I typically have seen is that they require a history of giving. So if you can demonstrate, like, I have a history of giving to this charity, or maybe I'm on the board. Maybe whatever it is that shows that you are a true key donor rather than that you just picked this charity this year. But I've got a history with this organization that can be really, really helpful for underwriters to be more comfortable with the charity owned policy.
Absolutely. And really, these types of strategies, they are the first types of strategy we talked about were really targeted around like creating benefits for ourselves today. These strategies are really more creating benefits for the charity. So it lines up, that you're
Yeah.
someone who does have that history of giving and that you've been, giving to that particular cause.
Yeah, absolutely.
So getting to the end here, kind of right on time. So just leaving a legacy, right? You know, say that charitable giving, I think all of us at heart are charitable people, right? It goes back to that seesaw, like we want to do the greater good, but we also want to make sure that we take care of ourselves first, right? So, what I hope you got from these strategies is that you can benefit everyone, right? Yes, you can be charitable and leave a legacy, but still have benefits for yourself and benefits for your family that are greater than even the amount that you give to charity just by looking at these different strategies. And then the final point here is kind of this is all of these strategies need to be part of a fully integrated plan. You can't, I'm not a big fan of making any financial decision in a vacuum, let alone one like this that has so many different moving parts. So we'd want to look at what your entire financial picture looks like so that we can see what strategy makes sense. Is it A? Is it B? Is it C? And then how does that line up with what your goals are? And then we bring various professionals to the table, right? And there's different things that we talked about there. We absolutely would always be making sure we're talking to your attorney, your estate planning attorney. If we're drafting documents, right? That's their job. That's not our job, right? We're talking about tax deductions. I'll do a rough estimate, but your CPA is the one who has all of those numbers. So they will absolutely be involved in that discussion. You're the life insurance expert, which is where we can fill that seat as well as the planner. Your investment advisor, if it's a trust, there's also a TPA oftentimes that, is the one who does the trust tax returns and all of that. So there's a lot of different professionals that come to the table that say, wow, this is what needs to be done to make this work and keep it everything on the up and up. But it can be done and it has numerous positive benefits. So that was everything that we had for tonight. So I appreciate everyone joining. I'm going to take a quick second to see if there's any new questions in the chat. So give me 1 second here.
Yeah, and I got one question. I get this question a lot, which is about the Secure Act and the 10-year rule, which is are Roth IRAs subject to the 10-year rule? And I think to your point, Michelle, that you still have a 10-year force out with Roth IRAs, but when it's properly structured, it's income tax free to the beneficiary. So it's really a gift to your heirs to do the Roth conversion because then they're getting this income tax free benefit. Yes, they still have to take it over 10 years, but it doesn't hit as hard as if that was fully taxable. So I get that question all the time. So I thought that was something I would add in.
Absolutely. One question that was in the chat was kind of how do I know if these strategies would be appropriate for me? Right. And which I think is a great question. And the reality is, until we would have a conversation, we don't really know. Right.
Yeah.
When I have my planner hat on, when I'm talking to you and finding out about your financial picture and what your goals are, I have all of these in the back of my head, but I'm asking questions of what your goals and what you want to achieve to see if they're even things that I bring up. Right. So I think it's always important to stress, to have that confidence and have someone who's doing a holistic financial plan for you to really say, okay, what are the different strategies? And, you know, Jenny, you could have a twin sister, right? And your plan could look completely different than hers.
I'm
Because
sure it
you
would.
might have, right? You have different goals, you have different strategies, your assets are owned
Yeah.
differently. So everyone's an individual, but we always come with a blank canvas to say, what do you want to achieve? and then let me bring my paintbrush and paint you some different pictures to see what fits best for you and your family.
I love it. Awesome.
All right. Well, thank you everyone for attending. Jenna, thank you for joining us this
Thank you for
evening. I
having
know
me. It
you've
was
had
a
a
pleasure.
busy week. Um, yes. And the recording will probably go out in a couple weeks. And if you are watching this to the very end, obviously you know how to reach us. Love to hear from you. Have a great night, everyone.
Bye-bye.
Bye.